Welcome to part 2 of the trend following series. Today we're going to go into more depth about the backtests I did regarding trend following in the futures. If you didn't watch the first video yet, I suggest you do so now by going to the Trading Educators YouTube channel and watching it. Otherwise it might be hard to follow this. So before we jump into the backtests, let's go through some of the things I had to consider when doing a backtest for the trend following strategy. The difference here between other strategies is that we might be in a trade for quite a while, so easily for weeks, if not even months. So we have to think about some things differently than usual. We're going to do the backtests on many markets, many different markets, so we also have to do some considerations there. So first of all, it's important to use the continuous contracts in the right way, the way you would actually use them when you're trading. So decide on when you roll over into a new contract and then use that as your data. Also remember to consider commissions for the rollovers you have to make, and don't forget slippage. You have to pay in the markets depending on what you're trading. In the S&P 500 it's going to be a lot less than in the OATs, for example, and also consider the tick sizes. So in the E-mini Dow a tick is $5. If you also trade gas oil and want to compare both of these markets, then you have to consider the difference in the tick sizes. And another important point is to make sure you backtest with the currency exchange rate. So if your account is in euro, for example, and you trade something in US dollar, you have to apply the exchange rate of euro US dollar, or the other way around if it's the US dollar based account, because between these trades, if you have a trade open for a couple of weeks, a lot can happen in the exchange rates and you want no surprises here, so you need the exchange rates at the points when the trades happened. Also, don't use any of the simplistic retail backtesting platforms, because what they're going to do if you backtest a basket of markets, like you put in 50 markets with the same strategy, what's going to happen back there is they're going to run each market separately and then just put the results together at the end. So they won't consider what was the margin at each point of time in the simulation with all 50 markets, or what kind of equity risk did you have in between. So that's not going to work. In other words, you need a more sophisticated solution here. Okay, let's go into it. So first of all, here's a little overview of the markets I considered. So I took agriculture related futures, bonds, currencies, energy markets, and of course some equities from around the globe and metal futures. And here's an overview of the data I used. So for some contracts I had data back to 1968. For other markets like the New Zealand dollar future, I had data only from 2004. But for most markets I have data about 30 to even 40 years, which is exactly what you need for that kind of a longer term backtest, because otherwise you won't get enough trades out of it. If you backtest the trend following strategy that trades not so often and you only have 5 years or 10 years of data, that won't tell you too much. So to do a very simple backtest, I used this strategy just to make the point here that trend following still can work. The strategy simply consisted of once a week we're going to go look back what was the closing price 200 days ago. If the close is higher than 200 days ago, go long. If it's lower, go short. I didn't apply any stop, trailing stop, or profit target here. So it's basically a get in or reverse strategy that works only once a week to avoid getting in and out of trades all of the time. So you get whipsawed less often instead of making that evaluation on a daily basis. For the risk, I simply took 0.1% of the account size and multiplied with 1 times the average true range of the daily price chart of the last 100 days. And then I run that over the whole time period, and here you can see the results. First of all, I have to mention that the equity price chart here is log scaled, because we compounded the profits all the time. Otherwise you would just get a curve that looks really crazy like this. So whenever you see some price chart that looks like that, it's probably not scaled correctly. So quick look at some numbers here. As expected, the average win trade is much bigger than the average loss trade. Same is true for the largest win trade and the largest loss. The maximum drawdown with about 34% is well in what I try to achieve here, with a very low risk of 0.1% per position adjusted to the volatility. Overall, we made a profit of over 10,000%. which is amazing, even though it did run over all that time, but this also shows the effects of compounding. With a profit factor of 1.41, which is quite good for such a strategy, a yearly profit of about 10%. Yeah, so again, this is really a very simplistic strategy, and I came up with some models that worked a lot better than that. You can, for example, look for different ways to get into the trades and combine longer and shorter term trend following approaches, and maybe even combine it with a mean reversion strategy to reduce the drawdowns. Here we can have a look at the drawdown curve. As you can see, a couple of times we came close to that 30% here in 1980 and also in 2014, but that's quite extreme times. Most of the time you get drawdowns of about 10, 15 or 20%. Here's another interesting statistics looking at the margin used in percentage. So how much of the margin did we use? Again, we started here with a $10 million account. And the highest margin we used was about 40%. Let's have a look at more details. So here's the results per month that we can look at. Some really bad months, like for example in 1980. Some really good months, like 2008 for example, which was right in the financial crisis. But overall, the results have been pretty stable, as you can see. Same is true for the annual returns. So most of the time we made about 10%, but that's also very typical of trend following. And what you should be aware of, you're gonna have years where you make 30% or even up to 40%. And in between, you're just gonna have years where not much is happening. So either you lose some, or you just win some, or you end up more or less break even. That can go on for a couple of years until you have another nice winning year. Now, if we have a more detailed look at each of the markets, some are quite outstanding, like Palladium, for example. The equities, as you can see, most of the time don't do so well. The E-mini S&P, for example, or the Euro stocks. The yen is one of the best currencies. Also, gold is up in the top performing markets here. But all of this doesn't matter too much in a trend following approach. So in other words, it doesn't make any sense to start picking the best markets here. So you don't want to cherry pick. What you want to have is a nice diversification, because that's what's going to help you in years where, for example, the usual top performers like the commodities or some of the currency pairs might perform very bad. You want to have maybe the equities in that usually do much worse, but in that year they can just make up for the losses in the commodities. So here's a per trade result distribution, and all of this is measured in hours, and 1 hour in that case is simply 1 time the average true range. And again, no surprises here. As you can see, we have some really crazy outliers with up to 330 times the average true range. And another thing to notice, of course, is that on the downside we don't have that. So on the downside, the finishing line is pretty much here, which I think first one was about 10 or 15 hour. So here you can see all of the markets performance plotted over throughout the whole time. And yeah, not much to see here really. We could have a more detailed look at a specific year now, but what you would simply see is that yes, some markets performed well, others didn't, and it's the same pattern you get when we now look through each of the markets. So the Australian dollar, for example, did pretty well most of the time, but there have been years where pretty much nothing really happened. So one thing to mention here is that these are the gross balance results. So you don't see the net balance all of the time. It's simply, okay, trade might be open for a month here and then closed, and then you see that big jump, but you don't see what happened in between. So here's the pound, for example, didn't do very well for quite a long time, but then you have some years where it does exceptionally well, and that's when you want to have it in. Again, key really is diversification. Just trading the euro doesn't make sense, but you definitely would have wanted this in 2015. Now the yen is definitely the best performing currency here, and as expected, the commodity related ones like the New Zealand dollar performing worse. Cocoa is one of the markets that didn't have a good time in the last few years, but who knows, maybe this year it's going to be the market that's going to make up all the money, so don't want to throw anything out. Could go on with that for a long time, but here, for example, the last one, again, E-mini S&P, most of the time not a market that's performing very well, but then you have these years where you want to have it on board. So I hope you got something out of looking at these backtests and at the details of the reports. For me, it was a very interesting thing to do, to get an idea how a trend following fund would actually operate, what you would have to expect, and what to watch out for. And it was also interesting to come up with a strategy that doesn't depend so much on a single market's performance, but really where diversification is the thing that actually makes it a winning strategy. So again, I think for most retail traders, this is not very interesting at the moment. I hope in the future that the CFDs get more tradable. It might be really interesting to get into this. Otherwise, I'd say at the moment, it's nothing to actually consider to trade. So trend following is an interesting concept, but if you're a retail trader and you don't have a couple of $1 million on your account, it's not going to work out probably. If someone tells you do the trend following thing in a single market or do it just in equities or whatever, do your research, do your backtest, and then find out if it works for you. I figured out the classical approach doesn't work. This doesn't mean that some breakout strategies don't work well, they do, and you can use the same concept, so to say, okay, I'm going to try to get in, for example, intraday with a small stop and having pretty much unlimited upside by staying in the trade for a couple of days at least. So you try to enter on an intraday basis and then make a swing trade out of it, which in essence is sort of like the same concept. So thanks for watching. If you have any questions, just send me an email to marco@tradingeducators.com, or if you want, leave a comment down here on the YouTube section where the comments are, or if you're a member of our trading community, just go to the trading forum and post there.